Okay, so these are some new videos we're doing, calling it news you can't really use. And the basis here is that we're looking at articles that are in the media from a variety of sources that really have two things. One would be the bias is a certain way, and bias isn't necessarily incorrect. It's just a different opinion, sharing my opinions, how it differs, and why I think what they're saying is wrong. But specifically, too, we want to really look at a lot of media articles that are just giving totally bogus, inaccurate information, and like how that can affect you when you're like making your decisions based on information that um just has no basis in reality. So we're looking today at an article here that I've moved up the page called "The Market Warns a Bank of Canada policy area." So the idea behind something like this is that this is coming off Canadian Mortgage Trends, which is a mortgage broker website done by Rob McLister, who I have questionable articles. He is a mortgage broker, but um, the idea and the basis behind this article, and we will link the article that you can look at it yourself and come to your own conclusions. But the idea here behind the article is that um, with inflation running rampant, the Bank of Canada really acted too fast. One premise is being that the Bank of Canada should have increased rates, sometime last year, like 12 years ago, and they've really come to the table too late. Now, the one reason that this has some dose of reality is that you'll see that the Bank of Canada was trying to project 2% inflation, and they exceeded that quite some time ago. So fear of the Bank of Canada is too late has investors pricing in rapid rate hikes for the year. This is an interesting thing. So the premises behind the article is that Bank of Canada is too late and they're a year or two behind. But the idea here is that and we talk about this in a lot of videos, is that it's really missing the point of, yes, the overnight rate and rate hikes from the Bank of Canada is used to curb inflation. But it's really a misunderstanding, and we see this throughout the article, about the idea that, like, the idea behind inflation is that we need to slow growth. Too much is happening, things are going out of control. And that's not necessarily an untrue story in this day and age, but what it is it is not a all-encompassing view. You'll see that lots of industries, for example, if you get me on the phone, you'll see I talk about, yeah, housing is crazy, and there's unbelievable, robust statistics on that. But is there other industries in Canada that, as a result of COVID, have really had very poor numbers? And is this really a tale of two economies? Which I strongly believe that it is. The basis article too is that the idea is that they feel that the Bank of Canada will rise rates quickly and frequently without the idea that they'll completely tank them down the road. So this is really an interesting argument, is that the Bank of Canada would raise rates and then tank them within a year's time. Uh, Here's the problem with this thinking, is that, like, this assumes that, over if rate hikes were to happen on a rapid basis, this assumes that people would continue to buy. So, if I'm hiking rates up 0.25% every 6 weeks to 2 months when the Bank of Canada meets, that this presumes that people will continue to drive up consumer spending. So rates get higher, but people continue to go crazy for houses. Rates get higher and people continue to borrow more money. And that's just not in line with the psyche of Canadians. It's totally missing the data that says that, like, really it would not take, I feel strongly, maybe two rate hikes, that people would significantly rein in their spending and choose not to continue to buy. So remember, rates only go up when there is robust consumer spending and robust consumer activity, and so they go hand in hand. When the economy is good, rates go up. When the economy is bad, rates go down. And so the idea behind the article is that the economy is already turning towards it being bad, and so we need to rates should be heading down. So obviously, this it's really bogus, the idea that you could, that they would see that many rate hikes over a short period of time just to absolutely tank them. Like, it's just, um, it's just not possible. Now, if we move down here, interesting articles around the rate expectations, and I don't think that's all wrong. But obviously, my favorite subject here, variables. And basically, the idea behind is that, with all these rate hikes, interesting enough, says the variable give the slight edge based on his predictions, which I disagree with. But I think really, really the most dangerous part about this article is not pricing in the fact that people that people will pay out their mortgages early. We talk about this all the time. 70% of Canadians will pay out a mortgage early, and if that is true, then all bets are off. And this is where this, in my opinion, this article really goes off the rails and has bogus information. Um, so a borrower who can't afford, this is the, and I'm going to finish off with this. A borrower who can't afford to consistently save for retirement has no business in a fully variable mortgage. Uh, that is the most outrageous advice in the world. As you know, most of our variables are guaranteed. So a borrower that can't save would have to make a higher payment. That is so stupid. It's just not even. It's just not even possibly true. So um, the other thing he talks about is, as brokers, we can't get a caught in fixed rate IRD, interest rate differential penalties being too high. This simply isn't a threat with all lenders, let alone in a rising rate market where interest rate differentials shrink. This is completely inaccurate. It is true, as rates rise, there is many penalty situations where the fixed rate penalty shrinks. But first off, the penalty never shrinks where it is a lower number than a variable. And this is very dangerous advice. Very dangerous advice, because even though it's true that some of these will shrink, they'll be no means all of them. And how an interest rate differential penalty works is that if I take out a 5-year term and then I pay out my mortgage 3 years in, it means that the bank charges me the difference left on their um, if I'm 3 years in, they'll charge me what they're lending out the 2-year term on. Here's where the thing is. Here's where this is really, really important to be to be aware of, is that the 2-year term is often higher than a 5-year term. So it's not true that this would happen, and the risk on interest rate differential is meaningful. And to say borrowers who can't consistently save for retirement, it is complete hogwash and very much scares me on what's going to happen. So anyway, those are just my takes on the article. You might have some other comments. You might disagree with me, and that is okay. Put your questions down below, and we'd be happy to do that. But hey, more important, one thing that I have to agree with is that with the volatility of interest rates, it's just so important we look at your individual situation and talk about the risks and concerns. Yeah, I'm a big variable guy, but we're going to talk about some disadvantages on variables, some disadvantages on fixed, and so forth. So anyway, that is your news you can't use today. And let us know any questions. Subscribe to our channel, share this video however you can, and feel free to leave a comment.